Okay, so let's carry on with part 2. We're looking at the types of interest rates, and now we're looking at the repo rate. So the repurchase rate, or also referred to as the repo rate, is the interest rate at which commercial banks can borrow money from the bank. When the repo rate changes, it affects the prime lending rate. But then again, the prime lending rate in turn affects the interest rate that commercial banks charge their clients. The interest the banks will charge you when you want to borrow money from them. So the repo rate is one factor that controls the supply of money in South Africa, and which in turn influences the following: inflation, consumer spending power, so what we have to spend, national debt levels, and business growth. When the repo rate is lowered, money supply is increased. So when the repo rate is lowered, it affects money supply, and in other words, it increases the money supply. So it provides individuals and businesses with the opportunity to borrow money at favorable rates. In turn, encourages it in turn encourages business growth and consumer spending. However, an increase in money supply. So here, when the money supply is increased, makes the currency more vulnerable to inflation. So here we looked at when the repo rate is lowered, the money supply is increased. But look at the last bullet. When the repo rate is increased, the money supply decrease. So you see, remember that. So when the repo rate is lowered, money supply increase. When the repo rate increase, money supply decrease. So it will always be, if the one is low, the other one will be up. If the one is up, the other one will be low. All right. That's how they effect. That's the effect that the repo rate has on money supply. So it helps to keep inflation down, but discourages business growth and consumer spending. You see, here, when the repo rate was lowered, it encourages business growth and consumer supply. But when the repo rate increased, it discouraged business growth and consumer spending. All right, so understand that, because money becomes very expensive to borrow. See, here, money was, when the repo rate was lowered, to borrow money was more favorable, lower interest rates. But when the repo rate was increased, it becomes very expensive, more expensive to borrow money. So you must just understand that. Okay. This type of increase places a significant strain on businesses or individuals that have overextended themselves with debt. So when the interest rates were lower and it was more favorable to borrow, people borrow a lot of money. Now suddenly the interest rates increase, and now you have to pay more back, and now it eats your budget, and now you cannot put butter and jam on your bread anymore. You just eat dry bread. So when the repo rate is increased a few times in succession, this is usually followed by an increase in bad debt. So if they increase the repo rate uh, every now and then, higher, the interest rates go just higher. And that will cause bad debts, vehicle and property repossessions, liquidations, and bankruptcies. Okay, so the prime lending rate, when one borrows money from a bank, they usually specify the interest rates that the bank will charge one in terms of the prime interest rate. So the prime interest rate or prime lending rate is a benchmark rate used by commercial banks when issuing variable interest rate loans to clients. The South African prime rate is 3.5% higher than the repo rate. Okay, so it's always 3.5% higher than the repo rate. Banks can lend money below prime, at prime, or above the prime rate, depending on variables such as the loan risk. That is why they normally look at each person individually and they decide, are you getting prime plus 2 or prime plus 1 or prime minus 1? And if you are a very good client and you are a very good borrower with a good track record, some people also get prime less 2%. So it all depends in which bracket you as a person fall. I look at your history, um, how much money you borrowed in the past, did you make all your payments on time, did you fall behind, are you a high risk, low risk borrower, and then they decide what risk and what prime rate they're going to give you. What rate they are going to give you, above or under prime rate, or the same. Okay, when you look at nominal interest rates, the nominal interest is also known as simple interest. It is the interest rate stated for a specific product, calculated on an annual basis, and does not take the effect of compounding into account. So you get normal interest rate, simple interest as they refer to, and you get compounding interest rate, which we'll just discuss now. That is what they talk about. It does not take the effect of compounding in account. Typically, a standard fixed deposit would attract a nominal interest rate as it is set for a specified period and interest. Therefore, it cannot be added to the capital amount until the end of the period. So you must wait until the end of the period to add this standard fixed interest rate, nominal interest rate. Effective interest rate. The effective interest is the actual interest rate that accrues after considering the effects of compounding. Compounding means that interest is added to the capital amount or balance of the account periodically. Tongue twister there. So you invested money and you must get, let's say, 10% interest every month, which they sometimes they pay out. And then you said, no, reinvest the interest. Reinvest the interest. So now, whatever, let's say you had 1 million rand and 10% interest was 100,000, which you were supposed to get. And you says, no, take this 100,000 interest and add it to this. So now I've got 1.1 million. And the same next month, I add another 110 because it's 10% or on 1.1. And you said, no, take that interest, add it again, and then it will be 1.21, for instance. And so on and so on. So you constantly put the interest back. That's compounding interest. Typically, a notice deposit account or ordinary savings account would attract an effective rate of interest. Fixed and variable interest rates. Depending on the product, clients who agree with the bank might be given a choice between fixed or variable rates. Banks offer a vast number of products, and some of these products have standard options, which means that the client would not be given an option and that the rate would be either fixed or variable. So some products got variable rates, some products got fixed rates, and some products you can choose. Um, I know with home loans, normally you can choose between a fixed rate and a variable rate. So fixed interest rates. A fixed rate is a set rate and cannot be changed for the full period of the investment or full period of the loan. So yes, normally if you've got like on credit cards or personal loans, they give you a fixed rate and that's it for the rest of the time. You cannot choose between that. So if a client fixes the rate of a loan, it means that the client's repayments will not vary. They will remain constant throughout the period of the agreement. They will stay the same. Doesn't matter if the interest rate drops, you will pay that at the end of the story. This type of option provides certainty regarding a client's repayments or interest earnings for a specific period. It might be interest. You invested money and they said, okay, this is the fixed interest rate that we will give you. Protection against the upward movement of the prime rate, the fluctuation of interest rate, but which is good. If the interest rates are going up, your fixed interest rate will not go up, it will stay the same. So that is on that end, you will score and you'll reap the benefits. An alternative to the variable interest rates for the clients who hold the view that the rates might increase soon. So if the rates go up and you've got the fixed rate, you will score because your rates will not go up. But on the other hand, if the rates go down, you will lose because your fixed rate will not go down either. It will stay the same. When the client discusses this option, it would be advisable to inform him or her that the rates can fluctuate and that even economists cannot predict the future of interest rates with absolute certainty. It is also essential to explain to the client that once the term of the investment or the loan agreement expires, a new agreement will have to be entered, which means that the new rate would apply. It could mean that the repayments on the loan might increase or the interest received on the fixed investment might decrease. So you've got the term, and if that term is finished, then the banks will discuss the new rates. And if the rates went up, they will fix it at the higher rate. Or if you invested money and you got, let's say, 10% every month, but the interest went down, they will say, okay, from you wanted to invest it for, let's say, 5 years. Now you want to reinvest it for another 5 years. But because the interest rate went down, you will not get 10%, you will now only get 6% or 7 or whatever the case might be. All right, now look at variable interest rate. This rate is typically used for products such as home loans. A variable rate is linked to the prime rate of interest, which means repayments may fluctuate as the prime rate moves up or down. So if you've got the variable rate, if the interest rates go up, you're going to pay more. If the interest rate goes down, you're going to pay less. The fluctuations in the prime rate affect the interest charged and the monthly repayments on loans or interest received on investments. So it works the same for investments. If the interest rate goes up, you will get more money on your investment. If the interest rate goes down, you will get less money for your investment. So we look at the second bullet, clients who believe that interest rates are likely to drop in the short term who have enough capital to withstand an increase in the interest rate would generally prefer this option. So if you believe it's going to go down, people go for variable rates. Or if you believe it goes up, you will also choose that if you've got an investment. The benefit of choosing this option is that interest rate could change, lowering the repayment on the loan or increasing your disposable income. So then you've got more money to spend. Or provide the client with an option to continue paying the same amount on the loan, thus increasing the loan period. Decreasing, sorry. Thus decreasing the loan period. So instead of 20 years, you're now going to pay it in 16 or 15 years, your bond, saving the client money in the long term. And there in red, you see I put there, this will be a very advisable and smart option. So let me just show you some calculations. Let's have a look here on top. Um, so let's say you got a bond and you pay 10% interest. All right, and you bond payment is 10,000 rand per month, and you can hardly afford any butter or jam for your bread, but you've got the house, nice, well done. Now the interest rate comes down, let's say for 2%, so now you must only pay 8% interest. It means, let's say that have an effect that you pay 8,000 rand a month. So now suddenly you've got additional 2,000 rand a month to spend. But don't go buy butter and jam yet. Look at this. You must pay 10,000 rand a month over 20 years for that nice house you bought. Now the 8,000, because the interest rate come down, it means you're gonna pay less, but still over 20 years. But look, the trick I could show you. You take that 2,000 rand and you tell the bank, this 2,000 you must pay on capital of the outstanding bond. So they put it in the capital. What effectively your capital amount will come down. So instead of you, let's say you bought a place for R1,000,000, now every month they put 2,000, it will come down, down, down. So you will still have the effect of paying that 8,000 plus this 2,000. So you still pay 10,000, but now you put that on capital. So now this will have an effect that your 20 years might come down to 16 years you have to pay. So you pay the house now in 16 years instead of 20 years. So that is why I said this is very advisable. If the interest rate come down and you save this money, this 2,000 rand, don't spend it. Pay it on the capital so that the capital amount is still, the outstanding amount comes down. My brother bought himself a vehicle and he exactly did this. His first payments was 8,000 rand, and then the interest rates fell down, and then suddenly he had to pay 7,000, I think 7,400. He phoned the bank and he said, still take 8,000, but the extra 600, put it down on capital. He financed that vehicle, I think he said for, I'm talking under correction, I think he bought it over a 7-year period, 8 years. And because he was doing that, put that 600 and capital down, he scored 6 months. So now you only have to pay 7.5 years instead of 8 years. So he scored 6 months, and yeah, so he's going to pay it quite soon. And in fact, he's paying it off at the end of this year, and he was supposed to pay it off next year. So yeah, that is got a nice effect. So let's look at the last bullet. On the other hand, investors would be negatively affected by dropping interest rates, as it would harm the growth of the fund. So yeah, if you've got an investment and you get 10% and now suddenly you get 8%, you're not going to be very happy because now you're going to get less money. So the amount of interest that the client will earn will decrease. So decreases and increases in rates are effective immediately. Now we look at tiered interest rates. Tiered interest rates refer to rate of interest scaled according to the amount invested in the account. So that interest rate is linked to the amount. So the more money you've got in the account, the more interest you're going to get. The less money you've got in the account, the less interest you're going to get. So let's see here. The higher the balance in the account, the higher the rate will be. Savings or investment accounts with longer terms generally pay higher rates than accounts with shorter terms. This option is beneficial to clients who intend to save continuously and increasing the balance on their account. The more money the client saves, the higher the interest rate paid for the money. And if the interest is capitalized, the balance will increase even further and the client will earn interest on interest. All right, so if you get your interest and you put it back, you'll get interest on interest. Then the money is growing rapidly. Each bank has its process in place for accessing interest rates. Interest rates for most products are usually advertised on bank websites, and employees can access interest rates information either electronically or manually. So below is an example of interest rates advertised by a bank for a short-term deposit product, and you also find it there in your study guides, your books. So let's look at the left-hand side balances from 1,000 Rand up to 9,999 Rand and 99 cents. So we look the term 8 to 31 days, you'll get 2.15% interest. Less than a month, longer than a month, 4.73. The 2 months and more, 4.81%, 3 months, 4.89, 4 months, 5%, 5 months, 5.5%, and 6 months, 5.8%. If you look on the right-hand side, when you have balances from 10,000 up to 100,000 Rand, if it's between 8 to 31 days, you see, then you get 3.1% interest instead of the 2.5. So you get the whole 1% more. Yeah, bigger than 1 month, 5.73%. You see, it's 1% more than the 4.7. And the same, 2 months is 1% higher than the 4.8, 1 year, the same year. So just because you've got 10,000, you get 1% more on all of them. There's 6%, there's 5%. There's 6.5%, there is 5.5%. And here is 6.08% for 6 months, and there is 5.80. So instead of depositing that amount, add 1 cent. Then you can jump over to this one. Then you've got 10,000. And then you get immediately 1% more on your investment. Come on. You should be able to scratch 1 cent there in your house somewhere under the furniture or somewhere. Okay, so we have discussed the price of money and concluded that the price paid for borrowing money from a bank is called the interest. Price is one of the differentiating marketing instruments that generate an income for a business. Price can be defined as the amount of money that is charged for a product or service. Clients are prepared to pay for the use of products and services, and banks have various pricing options available to match a client's requirements. Price can be used to maximize profitability, increase market share, sales growth, and differentiate product types. Price is often associated with quality, so the higher the price, the better the quality of the goods and services provided. And you can just think of cars. Nothing wrong with a Toyota or a Nissan or a Opel and so on, or a Ford. But man, does it really compare to Rolls Royce, Porsche, Mercedes Benz, BMW, Volvo, Audi? No. That's why you pay less for these types of cars than for the others. Because the higher the price, the better the quality. That is how it works. And same with all other products. Banks generally structure their prices according to the pricing principles such as the client's needs. What products and services are clients looking for in the current economy? So then they look at that and they try to develop and market products according to the client's needs. Current pricing, what products are regarded as expensive, what products are selling or not selling, and why. You want to focus on the products which sells, and the ones who are not selling, you want to get rid of them. But you also want to know why, the reasons. Competitor activity and market share. So what are your competitors doing and what share of the market do they have? What prices are competitors charging? And should Bank A charge the same price? Should you charge the same, less, or more? Some people charge more because then people think, it's a better quality of service. Talking of that, I had a friend, she worked in a jewelry store, and we all know this watchmaking product, Citizen watches. Citizen watches are deemed as high quality watches, wrist watches, Citizen. And I walked in a jewelry store and I couldn't believe Citizen watches for 300 Rand a watch. And I told her, wow, why are they so cheap? Are they fake? She said, no, they buy them from Citizen. They get them from Citizen as their supplier. I said, but why are they so cheap? She said, Yaku, we buy them for half of that price. We add another 150 Rand. But the things are just lying here. People don't buy it. And then I asked her, but have you ever wondered why they don't buy it? She says, yes, they walk in here and they said, for 300 Rand, that must be a fake. They put it down and they don't buy that Citizen watches. So I told her, but they've got a valid point because we don't pay 300 Rand for a decent stainless steel Citizen watch with a stainless steel strap. I told her, push that prices up, make it 1.5 because that is what people are paying for Citizens. So she said, no, but if they don't want to buy it for 300 Rand, how are they going to buy it for 1.5? I said, try. Because now they think it's fakes. So she pushed the price up for 1.5 for that same watch. She took off the 300, she put the 1.5. I went back to her, I think 2 or 3 months later. There was not one Citizen watch. And I asked her, where's that cheap Citizen fake watch? She says, Yaku sold a lot for 1.5 each. I said, yes, you see, because people expect to pay a quality price, a high price for a quality product. They're willing to depart with 1,500 Rand for a Citizen watch because it's a quality watch. For 300 Rand, they think, no, this must be a fake. So, yes. So, know the reasons why. So, then sometimes, if you give a better quality of service, you can charge more. You don't always have to charge the same or lower. How many clients use the home loan product at Bank A opposed to Bank B? Will a change in price successfully target the clients at Bank B, or is a price not the reason for Bank A's lack of market share in this product? Banks generally structure their prices according to the pricing principles such as inflation, the market environment, and how well the economy is performing impacts on price. The Reserve Bank interest rate fluctuations. The repo rate influences inflation, as we all know, therefore also price. So what is the price options? The South African banks are different from the banks in many other countries in that they charge a fee for almost every service associated with a bank account. Banks offer a range of pricing options to consumers. Now, the two main options are discussed below. So, bundled package options. If you look at bundled package options, it's a fixed fee for a specified number of transactions. They will say, we charge you 90 Rand a month on this account, but then we include all these things. 20 ATM withdrawals for free. You can access your internet 10 times, this and that and that. So this pricing option depends on the product. The package deal refers to a specific number or bundle of transactions charged at a fixed fee. Limits are placed on the type and number of transactions that are included in this bundle, and each package deal also has specific restrictions attached to them. The client would need to be aware that if the transaction limit is exceeded within any given month, there would be additional charges. So they'll tell you for 90 Rand a month, you can have 20 ATM withdrawals for free. After that, we charge you 120 or whatever the case might be. All transactions that are excluded from the package, such as cell phone banking, will be charged at the normal pay-as-you-transact rate. And some banks also offer free banking service options, but the client would need to maintain a minimum deposit in their account. The client will pay per transaction at the usual rates that would apply to that specific account. So an example of a bundled package option. We look at Fish Fin Bank pricing option fixed fee. Note, transactions above the maximum specified in this table attract the standard transaction rates. So if you look at in the middle here, we've got option A and option B, and then we also got option C here on the right hand side. Transactions, electronic transactions, if you look at this one. So option A gives you 30, option B gives you 40, option C gives you 50. Annual card fee, it's included with all three of them. Internet subscription is included in all three of them. Bank cash withdrawals. Option A, you only get 3. Option B, you get 5. Option C, you get 9. But let me make this a right mark there as well. A bank branch cash deposits. That is when you go into the branch. Option A gives you only 2. Option B gives you 4. Option C gives you 6. ATM deposits. You're only allowed 2 with option A, 6 with option B, 10 with option C. Electronic statements and balance inquiries, you are limited to one a month in option A, 2 a month with option B, and option C it's unlimited. And now when we look at the monthly fee for each one, yeah, option A you pay 95 rand, which is cheaper as option B's 140 rand, which is cheaper than option C's 175. So you must decide which one of these packages, A, B, C, you want, but then you must be willing to part of that, either 95 rand a month, 140 or 175. I also had to look at that when I opened my bank account. Yeah, and I had to just decide which one I'm going to choose. Package restrictions. Transactions fees will be levied on withdrawals made at other banks. So if you bank with Bank A and you go to Bank B's ATM because there's not another ATM, you know you're gonna if you withdraw, you must pay that bank a fee. Additional transaction fees will be levied if the allowed number of transactions per month is exceeded. Electronic transactions include all and any combination of inter-account transfers, account payments, debit orders, and check card transactions. The internet banking subscription is only free for the primary user and not for the rest of his family. Monthly statements posted to the client attract a fee of 750 per statement. When you look at unbundled or pay as you use package options, so here you don't pay, you don't have option A, B, or C, you pay as you use. If a client chooses this option, they are charged a fee per transaction. So for every little thing you do, you're going to pay. But then you don't have to pay that monthly fee. The fee is charged, i.e., whether it is a flat fee, a single fixed fee, or ad valorem fee charged based on the value of the transactions, will depend on the type and the value of the transaction. Other than transactional fees, the client will also be charged subscription fees or monthly fees and any penalty fees that may apply. Yeah, you see, so some will charge you pay as you go, but still charge your monthly fee as well. But they won't give you an option A, B, C. They'll just tell you, we don't have option A, B, and C. We charge you 30 rand a month plus as you go. The various fee will differ depending on the product that the client has chosen. An example of a pay-as-you-use option, pay-as-you-use option on a personal check account for Fishfin Bank. You see, there's no option A, B, and C. That is what you're going to pay, and that's it. So, clients are charged for each transaction at the current published fee. The total charges on an account will vary from month to month. So your monthly account fee, it's a flat fee of 45 Rand a month. There's not an option A, B, or C. You're going to pay 45 Rand. For each debit order, you're going to pay 350. For each check card transaction, another 275. Cell phone banking, great stuff. That is for free. ATM and online banking, you're going to pay 350. Over the counter cash withdrawals, you're going to pay 20 Rand plus 1.25% of the value, up to a maximum of 1,500 Rand per withdrawal. So, yeah, let's say you want to withdraw 1,000 Rand, they're going to charge you 20 Rand plus. What is 1.25% of 1,000? If I'm correct, 10% is 100 to 1%. So it will be 12 Rand 50, if I'm not mistaken. So for withdrawing that 1,000 Rand from the bank, you are going to pay 32 Rand 50 cents extra. Over the counter cash deposits, and the same goes. Every amount you deposit, you pay 1.25% of the total value with a minimum charge of 20 Rand. So if you want to deposit 1,000 Rand, they're going to charge you 1.25 of the value with the minimum charge. So they're going to charge you 20 Rand, so they will deduct 20 Rand. So you'll only be banking 980 Rand. Statements for email statements is for free. For post, they'll charge you 750. Balance inquiries is 325. Penalty fees for you've got unpaid debit orders, 130 Rand for each debit order that bounces. So if you've got 10 debit orders that bounce, it's 130 times 10, they charge you 1,300 Rand. Card replacement, if you lose your card, which happens to me frequently, this is a bargain. They only charge 55. My bank charged me much more than that. So unbundled or pay as you use package options. Every bank has their own set of pricing options. So you must look at between bank and bank. And it is essential that advisors get to know these packages, as this will contribute to the success of the needs analysis performed and the client's ultimate product choice, especially when doing cost savings exercises. And that is the end of part 2. If you've got any questions, please feel free to send me an email. There's my email address, jaco@ireland.co.za, and I will gladly answer your questions. Best of luck. See you on the next part.